Look, Nvidia is more than just a semiconductor firm. It is the operating system of the future. In trillion-dollar markets like AI, the metaverse, and driverless cars, Nvidia is the key. Folks, we're talking about a 50x potential. It's obvious, it's not a gamble. Up until now, Intel was essentially the mother of all modern computing. Isn't that correct? The CPU, in my opinion, was the most essential component that made local PCs, networking, and the internet possible. For instance, its market capitalization is currently at $180 billion, but the economy it built and sustains is likely worth $1 trillion, $2 trillion, or even $5 trillion. Let's just be incredibly giving, shall we? As a result, you may observe that there is a ratio between an economy's facilitator and its size, and that these factors are typically stable. They keep happening. The question for Nvidia, in my opinion, is not whether it will increase in the next 18 to 24 months. Given Microsoft's market capitalization in relation to the economy it supports, but rather whether it will, for the exact reason you mentioned. It is well positioned to have excellent meet and beat guidance for the street, which they will devour, and all of the algorithms that trade the press releases will raise the price. This will only lead to an upward trend. The more important question, in my opinion, is whether it can sustain a $100 trillion economy if its market capitalization is $4 or $5 trillion in the next 2 or 3 years. For those ratios to persist, you would have to think that. Otherwise, everything on the internet would have just collapsed. Microsoft showed its adaptability and foresight by using its market leadership in OS systems to break into and dominate other software areas, including server software, enterprise solutions, and even entertainment with Xbox. In addition to diversifying its sources of income, this multi-pronged strategy solidified its position as a full-service technology supplier. They will come if you develop it, as the Internet's history demonstrates. This means that even though it was difficult to foresee them at the time, apps that power the next generation of applications have always been produced if the capital assets required to power them are invested in. During the dot-com bubble and subsequent crisis in the late 1990s, all of the telecom firms built out a massive amount of fiber in addition to servers and networking equipment. WorldCom, Cisco, and other telecom firms were at their height. Some even filed for bankruptcy. The issue was that a large portion of the construction was financed by debt, which is why many failed when the dot-com bust occurred and valuations dropped. Cisco wasn't in that situation, but my point is that everyone believed that these telecom giants had overinvested in fiber when the dot-com meltdown occurred in the early 2000s. In the end, it turned out that all of that fiber was utilized. The internet transitioned from dial-up to broadband, and social networking, streaming, and other applications began to consume that bandwidth. Therefore, I believe that if you construct the infrastructure to support them, the apps will eventually be built and developed. As someone who is more of an application investor, the thing about AI that excites me is that I believe we are only beginning to see the vast array of new applications and innovation that will be developed. It will also be B2B. It is not just B2C. You haven't really addressed the fact that businesses will also be using these cloud data centers to purchase all of these GPUs in addition to consumers and consumer apps. There's still a lot to come, considering that these businesses are utilizing AI, Google Cloud, and other tools. This is only the start of a trend that is likely to continue for at least 10 years. All right, so the Nasdaq is down almost 1/3% today, but it has gained a lot of ground since Monday, the low 2 weeks ago. I bring it up because Bill Burrich is currently joining us via phone, and he's making some fascinating moves in that area. A few names have been trimmed by you: Nvidia, Apple, Amazon, Google, Meta. Is that a summary at the end? Would you mind explaining the rationale behind the removal of these mega-cap names? Yes, without a doubt. I came across several names and cut them all down by 10% to 20%. Listen, following that significant volatility event, we'd have had 8 days in a row of positive trading. Following that event, I appeared on the show a few times to share all of the purchases I was making. However, 4 rate cuts that were priced in with a 63.7% likelihood also contributed to this rise. Last week's better-than-expected retail sales and better-than-expected unemployment claims kind of contribute to Jerome Powell's performance this Friday. There is a lot of resistance at this point, in addition to the fact that the NAS. I want to be prepared for the instability that September brings, as Steph just mentioned. We only own 10 names in our focus portfolio, which we trimmed overall. However, Meta was our largest holding, which we trimmed by roughly 24%. Right now, I have nothing against any of these names. The goal is to give people additional options in the upcoming weeks. Okay, there may be some danger ahead. Let's see what transpires with your cherished stock. I'm going to advise you to purchase it with caution, Tyler. You have to wade into that water if you don't own it. The market's hottest spot is here. This stock will do well as long as the competition to develop AI and the race to acquire it continue. Over the next 5 years, they still anticipate a 40% increase in this company's earnings. With this significant earnings growth, it has decreased from 48 times 2024 earnings to 34 times next year. Despite the fact that it is a cyclical sector and likely has a few years remaining, the AI momentum behind those earnings, in my opinion, has the potential to propel this company higher, even at a $3 trillion market valuation. I believe that this is a dollar cost average in if you wish to create a position. You would like to have a position in this area if it were blank. It must be a suitable risk for your portfolio, but it need not be a whole position and must adhere to your investment philosophy and discipline. Consult your advisor. The first 50 customers receive 50% off anything in our store for a short period of time. This offer won't be around for long, so don't pass it up. Hurry now to save a ton of money. Be among the first 50, so act quickly. Use the link below to shop right now. No changes have been made to the length or meaning. All grammatical problems have been fixed. This should be a benign cutting cycle that is beneficial for markets since, in my opinion, the likelihood of a soft landing is increasing. However, since the Fed missed the inflation turn due to data dependency, I believe it is crucial that they stop using it. Additionally, I believe that they are now missing the softness. But might it be that the lag isn't because they're now overly restrictive? They end up completing 50 or a few 50s, and we don't know how strong the lag impact of the higher rates could be. Is that feasible? I believe the Fed is likely lagging a bit because futures markets are indicating more than 2 cuts. There is a lot of suffering since, as we all know, the housing, durable goods, and auto sales are all in a recession. In fact, cutting more aggressively might make sense, at least from the standpoint of the market. Since you're interested in market cycles, where do you believe unemployment peaks? Will we reach 5? Do we surpass the 5% unemployment rate? Since many businesses are currently apprehensive due to the tight monetary policy and real rates, a lot of it has to do with how the Fed interacts with CEOs. They are hesitant to grow as a result. As a result, the job market itself somewhat depends on the Fed's actions. Indeed, it might. Things could turn terrible once the labor market starts to see an increase in unemployment. Josh, Nvidia will be here next week. You briefly discussed it previously in the show. To remind people, we're going to display a visual right here. We don't discuss